Hello, friends. Today we're taking a look at Deere Company, ticker symbol DE. We'll be looking at the performance of the stock for the past 5 years, look at some analyst comments and projections, look at the last earnings report, and look at the last 10 years of revenue, earnings, free cash flow, and book value, as well as debt levels, dividend history, and try to find a fair value. Welcome to once again to Money Talks with Martin Reyes, where we learn to take care of our money and try to find great companies at great prices. Let's jump right into it. In the last 5 days, Deere has been going up for about 3%. I'm at 2.6%. In the last month, it is down 2.7%. In the last year, it is down to almost 6%. Low numbers in the last 52 weeks. It's somewhere around $345, and the highest in the last 52 week is $450. In the last 5 years, Deere has grown almost 150%. So those are really nice numbers, and this is part of the reason why a lot of investors like this company. But as you can see, since March of 2021, it has kind of traded flat for the past 2 years. They pay a dividend of $5.88, which is about at 1.5%. They will be reporting earnings on February 16, and analysts are thinking that it might get back to the price in the next 12 months, might hit the close to the 52-week high of 148, which will be about a 15% gain just on appreciation. For those that don't know who Deere is a company that makes machinery. They're one of the biggest sectors is agriculture. So they have three sectors. They have the production and precision agriculture, in which they have the big machines for harvesting and planting, and they use a lot of GPS and computer, to do those things. They also have a small ag and turf, which is lawnmowers and tractors, and they also do. They have a section on machinery when it comes to construction and forestry. So as you can see over here, most of their sales, 54% of their sales come from the United States. Then there's 6% from Canada, 13% from Western Europe. So that would be like Ukraine and all those areas, Poland. Central Europe is 4%, Latin American 4%, and the rest is about 9%. In the sectors, 48% of all their revenue, their revenue comes from the big production and precision agriculture, 25% on the small ag and turf, and then 27% on the construction and forestry. Let's jump into the last earnings report that they reported back in November 22nd of last year. They beat expectations with $8.32 or $8.26 in GAAP. They beat by almost $1, and they also beat revenue by $138 million. The upcoming earnings that will be reporting on February 15, and they're looking for a drop of almost 20%, somewhere around $5.21 reporting, and the estimate will be almost $3 billion less than last quarter. And as you can see here, in the last 90 days, there has been a revision. There have been 21 revisions, and all of them has been down. If we go over here and look at the EPS quarters comparisons, the because they're very seasonal because they had to do with agricultural. So I wanted to compare the forecast of this with the last year forecast. And last year, the consensus was $5.47, which is still a little higher from the consensus for right now. But they actually beat by almost $1. So hopefully that's what happens again. But as you can see, a lot of the investors of the what's this called, analysts, are not thinking that they're going to be beating last year's numbers. So that will be something to pay attention to. Let's jump right into the Excel. But before that, if you like what you are looking at, what you're seeing, and if you would like to subscribe, just click the like button or the subscription. If you are listening to us in podcast, please leave a comment too. And also, if you would like to get the Excel sheet that I'm going to show you, you can go to Buy Me a Coffee, my page, where I'm working on adding some additional perks for you guys, and just be paying attention to that. Okay. When it comes to revenue, they have been growing. They were very flat between 2014 and 2020. And then they experience a big growth. So as you can see here, in the last 10 years, their CAGR growth is 8%, and the last 5 years almost 12%, and the last 5 years when most of that growth has happened. When it comes to earnings, you can see that in the last 10 years, they grew 15% CAGR, and in the 5 year, almost 30%. So once again, they were flat for almost from 2014 to 2020, and then there has been an explosion on earnings. When it comes to profit margins, the profit margin is 13.5%. Free cash flow, once again, from 2014 to 2019, pretty flat. Then they jump really high, and they have kind of stayed up there in the 20s per share, $20 per share, except this 2022 dropped to almost half of that. In the last 10 years, it has grown about 14%, and in the last 5 years, 32%. Those are great numbers, but I'm still a little worried about these big jumps, if they can continue that, because that can create a lot of issues. I know here in the United States, there was a big bill that for construction and infrastructure. So a lot of these companies probably got a lot of orders and money coming from that. When it comes to free cash flow, they're under 10%, which is not bad. Book value has been growing steady, kind of steady. In the last 10 years, growing about 11.5%, and in the last 5 years, above 15%. Return on equity is 37%, which is great. Return on assets is 7.5%, which is great. And then return on invested capital at 10% is okay. When it comes to the dividend has been growing, even though it was a little flat for almost 4 years. It's been growing since then. CAGR of 8.5% and 10% in the last 10 years. With the payout ratio pretty low, which is good. That means that they have the space to increase the dividend. The payout ratio is almost 17%. When it comes to debt, this is the part that I am a little concerned about. The debt has been growing, but not only that, is that it will take them 12, almost 13 years to pay their debt using their free cash flow in the average of the past 5 years. And remember, the average of the past 5 years is really, it's almost 4 times what it used to be. So if they were to go down back to the $5 or $6 average that they had, I am kind of concerned of what is going to happen with this debt. When it comes to shares, they have been In the past 10 years, they have been buying back somewhere around 2.1%. That's really good. And in the last 5 years, 1.74%, also really good. Analysts are projecting a decline, just like I show you, of about 5% in the upcoming 5 years from where they are right now. So with those numbers, let's look at the historical multiple valuation, in which we look at the different per share numbers, and then we multiply them by the last 5 year multiples. It gives us a fair price somewhere between $321 to $431. When we look at the payback time in which we grow, I know that the analysts think that it's going to go down 5%. I think that they will still grow, especially because of some of the wars that are happening in agricultural areas. Argentina might be a place of growth for them. So I'm betting for a 5%. That will mean that the fair value is somewhere between $400 to $500 a share using the cash flow analysis. Whenever we look at the discounted earning valuation, growing it at 10%, and part of that is one of the things that I notice here is that 84% of their expenses are on cost of sales. So if they can get more efficient on this part, I think they could definitely improve on their margins here and get better results. So looking at that, the numbers will be somewhere between a fair value for this stock will be somewhere between $300 and $484. Looking at owners' earnings valuation, we're looking somewhere between $420 to $490. When we put all the numbers together, it gives us a fair value somewhere between $453 to, if we take the average, will be a little bit more conservative, will be $340. Now, if we were to take what I like to do, especially companies that are like this, that are nice, have good numbers, I probably like to take the most of the average, which will be somewhere around 350. The average will actually be, almost $400. So if we just put a 10% margin of safety, that will be somewhere around $357, which will take us to back to the December prices. So if you would like more of a 15% margin of safety, you will have to kind of wait until it gets to the 340s. Now, once again, I am just a YouTuber. I am not a financial advisor. Nothing that I say here is a financial advice. I'm just doing this for educational purposes. I hope that you enjoy today's video and hope to see you in the next one.